Here's a detailed summary of the FedEx Q2 Fiscal Year 2026 earnings call transcript, designed for clear and concise delivery. Good afternoon, everyone. Today, we're reviewing FedEx's second quarter fiscal year 2026 performance, a period marked by strong execution and resilience in the face of several challenges. Financial highlights and performance. FedEx reported robust Q2 results, achieving high single-digit revenue growth and high teens adjusted EPS growth. Consolidated revenue was up 7% year-over-year, primarily driven by strong yield and volume in their U.S. domestic package services. Adjusted operating income saw a 17% increase. The Federal Express Corporation, FEC, segment delivered particularly strong performance, with revenue up 8% and adjusted operating income growing by 24%, expanding adjusted operating margin by 100 basis points. Nearly half of this revenue growth was attributed to their B2B services, a key driver of profitability. This marks the fifth consecutive quarter of adjusted operating margin expansion for FEC. In contrast, FedEx Freight results remained under pressure, consistent with LTL industry trends due to lower volumes. This was partially offset by higher weight and revenue per shipment, reflecting a focus on revenue quality. Management's forecasts and outlook. Given the strong Q2 performance and updated assumptions for the second half of the fiscal year, FedEx is raising its adjusted EPS outlook to a range of $17.80 to $19. For the full fiscal year 2026, they now expect 5% to 6% consolidated revenue growth, supported by continued U.S. domestic yield and volume growth. FEC's revenue is projected to grow by 7% year-over-year at the midpoint. However, FedEx Freight revenue is expected to be approximately flat to slightly down year-over-year, with yield growth partially offsetting a low single-digit percentage decline in shipments. Looking ahead, Q3 adjusted EPS is expected to be sequentially lower than Q2, with revenue largely in line, but operating expenses increasing due to peak demand and higher costs from the MD-11 groundings. Q4 is anticipated to be their strongest adjusted EPS quarter. Significant risk factors. Several external headwinds impacted Q2 and continue to be monitored. MD-11 fleet grounding. The unexpected grounding of their MD-11 fleet has presented operational and financial challenges, estimated to have pressured Q2 adjusted operating income by approximately $25 million. They are working with Boeing and the FAA to ensure safety and facilitate their return to service, with current expectations for Q4. Nationwide air traffic constraints. These continue to pose operational challenges. Weakness in the industrial economy. This particularly affects FedEx Freight volumes. Global trade policy changes. Shifting trade patterns and policy changes necessitate ongoing network adjustments. LTL industry trends. The broader LTL market remains challenging. Key highlights and lowlights. Highlights: strong Q2 performance, exceeding expectations despite headwinds. Revenue growth and margin expansion, particularly at FEC, driven by B2B focus and operational efficiency. B2B strategy success. Nearly half of revenue growth came from B2B services, with wins in sectors like healthcare and automotive. Network transformation progress. Network 2.0 optimized facilities now handle about 24% of eligible average daily volume. AI adoption and digital solutions. Scaling AI across the workforce and launching new digital offerings like the ServiceNow collaboration. MD-11 contingency management. Successfully mitigating operational and financial impacts of the MD-11 grounding. Increased shareholder returns. Opportunistically repurchased nearly $300 million of stock and increased dividend payout. FedEx Freight spin-off progress. On track for June 1, 2026, with key leadership in place and regulatory filings submitted. Lowlights. Pressured FedEx Freight results. due to lower volumes and economic weakness. MD-11 grounding impact, causing operational disruptions and financial headwinds. Second half headwinds. Anticipating significant headwinds in the second half of FY26, including increased variable incentive compensation accruals, continued LTL softness, and the MD-11 grounding impact, totaling approximately $600 million year-over-year to adjusted operating income. Most important statements from management. Raj Subramaniam, President and CEO. Raj emphasized the company's resilience and flexibility in navigating multiple external headwinds, attributing their strong Q2 performance to embedded rigor, transformation efforts, and data-driven strategies. He highlighted the progress in network integration and optimization, and the successful swift implementation of changes due to global trade patterns and the MD-11 grounding. Raj reaffirmed confidence in the FedEx Freight spin-off, anticipating significant value unlock. He also stressed the importance of scaling AI adoption across all employees to equip them for the future, and spoke about the potential of their logistics intelligence insights through partnerships, like the one with ServiceNow. He concluded by looking forward to sharing more at the February Investor Day. John Dietrich, Executive Vice President and CFO. John expressed pride in the team's execution, driving margin expansion and operating income growth despite headwinds. He detailed the financial impact of various factors, including the MD-11 grounding, $25 million in Q2, and the expiration of the Postal Service contract, $30 million headwind. John reiterated the commitment to prudent capital allocation, with significant stock repurchases and dividend payouts. He provided detailed insights into the updated FY26 adjusted EPS outlook of $17.80 to $19, and elaborated on the $600 million in headwinds expected in the second half of the year, breaking down the impact of variable compensation, FedEx Freight, and the MD-11 groundings. He also confirmed the FedEx Freight spin-off is on track for June 1, 2026, with important regulatory milestones achieved. Brie Carrere, Executive Vice President and Chief Customer Officer. Brie commended the commercial and operations teams for their peak season execution and highlighted the 7% year-over-year revenue growth across the enterprise. She detailed the strength in FEC's U.S. domestic package revenue growth, up 12%, and the positive impact of B2B services. Brie acknowledged the continued pressure on FedEx Freight due to lower shipments, but noted the growing sales force and improved service quality metrics. She emphasized strong yield performance across all segments, driven by revenue quality actions and pricing discipline. Brie also touched on their vertical strategies, particularly in healthcare and the newly formalized data center vertical, and the successful use of digital tools to enhance customer experience. She provided an optimistic outlook for continued revenue growth, supported by peak trends and revenue quality. Actions. While acknowledging the need for adjustments due to the MD-11 groundings and fuel surcharge implementation. Overall, FedEx demonstrated strong operational execution and financial performance in Q2 FY 2026, showcasing their ability to adapt and overcome significant challenges, while setting the stage for continued transformation and shareholder value creation.